Did you know that not all states are retirement friendly, especially when it comes to their tax policies? Hey there, my name is Chichi Aguoji. I'm a New York-based realtor with a focus on helping seniors and retirees sell their homes and find the best locations to retire. In this video, I'm going to reveal the 5 states which eat up most of your retirement income in taxes. So without further ado, let's get into it. Number 5, Connecticut. Connecticut is known as the Constitution state, but for retirees, a better term might be the taxation state, given the many taxes that the state of Connecticut imposes on seniors and retirees. Now, as far as demographics go, when it comes to the senior population, according to the 2021 Connecticut Healthy Aging Report, 16% of Connecticut's population consists of seniors and retirees of the age of 65 years and older. 25% of this population are still employed. When it comes to taxes, Connecticut's income tax rate will leave a bitter taste in your mouth. Unlike most states, Connecticut taxes all forms of retirement incomes, which includes pensions, 401k distributions, or IRA distributions. Single filers will have a tax rate of 3% for income up to $10,000 and 6% for income up to $100,000. Now, as far as Social Security benefits go, certain exemptions do exist in the state of Connecticut. If you have an adjusted gross income, a federal adjusted gross income of less than $75,000 as a single filer, your Social Security benefits will not be taxed. If you have income of less than $100,000 as a joint filer, your Social Security benefits will not be taxed. But if your income is above these thresholds, then your Social Security benefits will be taxed. As far as property taxes go, Connecticut's average effective property tax rate is 1.96%. This is the 3rd highest property tax rate in the country. Median home prices in the state of Connecticut are around $365,000, which means on average you can expect to pay about $7,000 in property taxes every year. For sales taxes, the state of Connecticut offers a little bit of relief given that localities do not charge sales tax. So Connecticut has a flat statewide sales tax of 6.35%, but luxury items such as clothing or jewelry or high-end cars have a higher tax rate of 7.75%. As far as estate planning goes, Connecticut does have an estate tax. If your estate is valued at $9.1 million or less, you'll be exempt from paying estate taxes, or your beneficiaries will be exempt from paying estate taxes. If, however, your estate is valued at more than $9.1 million, then you'll be charged an estate tax of anywhere from 7.8% up to 12%, depending on how much your estate is valued at. Number 4, Vermont, also known as the Green Mountain State. When it comes to demographics, the number of seniors and retirees living in the state of Vermont is actually on the rise. And this is according to a report put out by the Vermont Legislative. Over the past 10 years, the senior population in the state of Vermont has increased from 10.9% up to 16.4%. And this is as recorded by the US Census. Something also notable is the decline in the working population of the state of Vermont. So taking a look at these 2 charts, what you see is that the primary supporters of the economy, people of the ages from 40 to 54, is actually on the decline in the state of Vermont. This is something that should raise red flags to you as a retiree if you ever were considering retiring to the state of Vermont, because the working population are going to be the individuals who are supporting the state economy through their income taxes. But if this population of people is on the decline, that's going to require you as a retiree to shoulder more of the burden of these state income taxes. So speaking of taxes, let's see how Vermont fares. So starting out with income taxes, much like the state of Connecticut, the state of Vermont taxes all forms of retirement income. So again, this does include your pension distributions, your 401k distributions, your IRA distributions. In fact, the only retirement income that the state of Vermont does not tax are federally distributed railroad pension benefits. But aside from this, all forms of retirement income and distributions are taxed in the state of Vermont. If we dig a little deeper to better understand the tax rates in the state of Vermont, what we see is that Vermont's tax rates on income ranges from 3.35% up to 8.75%. So single filers with income of up to $42,150 are taxed at a rate of 3.35%. And joint filers with income up to $70,450 are also taxed at a rate of 3.35%. Anything above these thresholds will be taxed at a higher rate. When it comes to Social Security, if you are a single filer with income above $25,000 or a joint filer with income above $32,000, you can expect to pay taxes on your Social Security benefits. This means that Vermont rules when it comes to the taxation of Social Security benefits are much in line with the federal government's rules in terms of how it taxes your Social Security benefits. When it comes to property taxes, Vermonters bear a heavy burden, having the 5th highest property tax rate in the country. And so that means if you were to purchase a home for $350,000 in the state of Vermont, your average expected property tax for the year would be about $6,500. When it comes to sales taxes, the state of Vermont has an average combined state and local tax rate of 6.24%, which is below that of the national average. As far as estate taxes goes, the state of Vermont does charge estate taxes for any estate valued at more than $5 million. So if your estate is valued at less than $5 million, you are not charged an estate tax, or your beneficiaries will not be charged an estate tax. But if your estate is worth more than $5 million, then your estate will be charged a flat estate tax of 16% in the state of Vermont. Hey there, if you're enjoying the video so far, feel free to like, feel free to subscribe, and let's keep going. Number 3, California. Although California is known as the Golden State, it is not all sunshine for retirees when it comes to taxes. Now, according to the Population Reference Bureau, 15% of California's population consists of seniors and retirees who are 65 or older. When it comes to income taxes, there's good news and then there's bad news in the state of California. So let's start with the good news first. The good news is that your Social Security benefits will not be taxed in the state of California. The bad news is that all other forms of retirement income is taxed in the state of California. And the tax rates range anywhere from 1% up to 12.3%. So single filers can expect to pay as much as 8% in income taxes if they make less than $66,295. They can expect to also pay as much as 12.3% in income taxes if they make more than $66,295. Now, joint filers can expect to pay up to 8% in income taxes if they make less than $132,590. They can also expect to pay up to 12.3% in income taxes if they make more than $132,590. The state of California does offer a senior income tax exemption, which is equal to double the rate of its regular tax exemption of when you file your income taxes. So this exemption allows you to effectively lower your tax bill. The exemption is equal to twice the rate of the standard income tax exemption of $129 if you're a single filer, and it's going to be equal to quadruple the rate of this number if you are a joint filer. Sales taxes in California are one of the highest in the country, so the average combined state and local tax rate in the state of California is 8.82%. But note that seniors are provided with some exemptions when it comes to these taxes, particularly when they're making purchases for prescriptions or specific groceries as outlined by the state. Property taxes in the state of California are low by percentage points. So the average effective property tax rate in the state of California is 0.76%, but you have to take this number with a grain of salt, given that the median home price in the state of California is $730,000. So when you combine these two and you multiply these two numbers together, you'll find that on average you can expect to pay about $5,500 in property taxes annually if you purchased a home that was priced at around the median price point and retired in the state of California. California does offer something called the homestead exemption, allowing anyone or any senior who is occupying their home to deduct $7,000 from the property value before taxes are applied to it. There are also some exemptions for seniors with disabilities or seniors who are blind, in that the state allows you to defer your property taxes and not pay them in the present year. Number 2, Minnesota. So Minnesota, otherwise known as the North Star State, is not that tax friendly when it comes to retirees. As far as demographics go, according to the Minnesota Compass, 17% of the state's population consists of seniors and retirees who are 65 years and older. So let's explore how these retirees are taxed in the state of Minnesota. When it comes to your income, all forms of retirement income are factored in to be a part of your adjusted gross income in the state of Minnesota. Single filers will have a tax rate of up to 6.8% with income below $92,230, and a tax rate of up to 9.85% for income above $92,230. Now, retirees are able to deduct $9,600 from their income if they're a single filer, and $12,000 from their income if they're a joint filer. However, this deduction is not available to all retirees. You have to meet certain income requirements and certain income criteria in order for you to be able to be eligible to use these deductions. Property taxes in the state of Minnesota are an average about 1.02%. So if you factor in the median home price in the state, you can expect to pay upwards of $3,000 in annual property taxes every year. And seniors with income below $60,000 are eligible for property tax relief programs in the state of Minnesota. When it comes to sales taxes, the average combined state and local sales tax in the state of Minnesota is 7.49%. However, note that all forms of medicines, whether prescriptions or not, as well as some types of groceries, are exempt from these sales taxes. When it comes to estate taxes, the state of Minnesota does have an estate tax, and this is for estates that are valued at more than $3 million. So if your estate is valued at less than $3 million, you will not be liable for an estate tax. But if your estate is worth more than $3 million, you will be liable to pay estate tax. And those tax rates start at 13% and go up to 16%. Number 1, Rhode Island. Now, although Rhode Island is the smallest state in our union, you'll note that 16% of the state's population consists of seniors and retirees who are 65 years and older. When it comes to income taxes, the state of Rhode Island taxes all forms of retirement income, including Social Security benefits. All filers, irrespective of whether you're a single filer or a joint filer, have the same income tax tiers. If your income is below $68,200, your tax rate in the state of Rhode Island will be 3.75%. If your income is above $68,200, then your tax rate in the state of Rhode Island will be 5.99%. Again, this is equivalent tax rates and equivalent income tiers, irrespective of whether you're a single filer or a joint filer. Rhode Island's effective property tax rate is 1.3%. So with a median home value of around $400,000, you can expect an annual property tax bill of around $5,200 each year. Rhode Island does offer seniors some property tax relief in the amount of $600 each year, but you have to meet certain income eligibility requirements. Sales taxes in the state of Rhode Island are charged by the state alone. So there are no city sales taxes, there are no county level sales tax. The sales tax rate in the state of Rhode Island is 7%. But note that some purchases, such as prescriptions or specific types of groceries, are exempt from these sales taxes. So this is important if you're a senior or retiree. The state of Rhode Island does charge an estate tax, and your estate value can be as little as $1.73 million in order for you to be charged an estate tax. Estate taxes range from 0.8% all the way up to 16% in the state of Rhode Island. So for example, if your estate is worth or valued at $5 million, you can expect to pay around $200,000 in estate taxes to the state of Rhode Island. Taxes are one of the fastest ways which eat into your retirement income or your retirement savings. So it's incredibly important that you have a solid understanding of all of the different ways you can be taxed as you consider a retirement destination. If you're someone who's thinking of selling their home and retiring into a new destination, and you would like an assessment of the tax landscape in your retirement destination, feel free to reach out to me. I would be happy to assist you. All right, that's it for this video. I hope you enjoyed the video. I hope you learned something new, and I hope to see you in the next one.